Welcome to Verde Capital Management's Fireside Chat. My name is Cindy Lundberg, and I'm one of 4 service advisors at Verde. I will be moderating today's webinar. All of our participants are on listen-only mode. If you haven't done so already, please find us on social media and click the follow button on Facebook, Instagram, and LinkedIn for some fun and informative content. During today's presentation, you'll hear from Carl Saz, President and CCO of Verde Capital Management, Eric Tomaszewski, Investment Advisor at Verde Capital Management, and Greg Marx, CPA and Principal at Robinson Petrus Kaliski & Company. There will be a Q&A session at the end of the presentation, so please submit your questions using the chat feature or by responding to the invite email. Now, without further delay, I'll turn it over to Carl Saz.
So on the agenda today, we're going to break this up into 3 sections. Section 1, I'll do, and it's called, we're going to go through the recession risk forecast, which is our recession risk indicator, and we'll talk a little bit about how we prepared for the COVID-19 recession. And then I'll give an update on our path to herd immunity. After that, I'm going to switch it over to my colleague Eric, who's going to talk about the current state of the economic recovery and what investments look attractive to us today, where we see risks and opportunities. And then for section 3, we'll turn that over to our special guest, Greg Marx from Robinson Petrus Kaliski & Company, and he'll talk a little bit about the economic stimulus, unemployment benefits, stimulus for individuals and companies, and then some tax saving strategies, which are very timely, given that many people are doing their taxes and are looking for those last minute deductions, deferrals, and opportunities. So let me start with our recession risk forecast. This is a tool that we've used here at Verde a lot, really, to kind of help us in understanding where we are and where we're headed. And I'd just like to start by showing you how our recession risk forecast got us ready for the COVID-19 recession. And so what you're looking at on this slide is our recession risk indicator is made up of 12 different variables that we track that have been very accurate at helping us forecast a looming recession. And as you can see, in 2008, those indicators were listed here, and we're mostly green. Green meaning, think of it like a stoplight. Green means go, yellow means be cautious, and red means stop. So in 2018, the indicator was pointing green, and of course the market was continuing to climb. By the second quarter of 2019, we started to notice that the indicator had significantly deteriorated at that point. And some of the individual indicators had already started to go into recession territory, like the yield curve or commodities. The yield curve being a particularly important one. The yield curve has been a very good forward-looking indicator at economic recessions, really ever since its inception. And simply what it is the difference between short-term and long-term borrowing. So it's the difference between borrowing for 3 months versus 10 years. And as you would expect, a 3-month loan should cost less than a 10-year loan. And if it doesn't, that might be an indication that over the short term, there's a very high risk, sometimes known as a recession, right? So the yield curve was at this point sounding an alarm, and the yield curve typically goes red 12 to 14 months ahead of a recession. So as you can see, by the second quarter of 2020, we were already in recession, and the yield curve was very, very accurate this time at forecasting that. But of course, by the fourth quarter of 2019, the overall signal was now yellow and was pointing to caution. So even though the signal didn't necessarily predict COVID-19, it did accurately forecast the looming recession and helped us to get ready for it. So what did we do? Well, at Verde here, we hedged currency. We started extending duration on bonds. We bought minimum volatility funds. We invested in gold, all of which helped us to really reduce the volatility of that recession for our clients. Now, what's happened since? And let's talk about this. This is one of the things that you might notice in the media often comes out when you get a recession, is the media will do very surface level analysis and mistake correlation for causation. Let me explain how this happened during the COVID-19 recession. When COVID-19 first hit, the unemployment rate skyrocketed. And the media looked at it and said, wait a second, unemployment's at 15%. When's the last time it was this high? Oh, it hasn't been this high since the Great Depression. Therefore, this must be like the Great Depression. That's not an accurate way of looking at it. That's really looking at it and saying there's a coincidence between this recession and the last one. and therefore they're the same. Causation allows you to look a little bit deeper and to figure out what is actually causing the unemployment rate to skyrocket. So, for example, during the Great Depression, it was bank failures. These are all people trying to pile into one bank and get all their deposits out. These bank failures caused a really kind of toxic downward spiral where banks, which are the lubricant that essentially turns the wheels of capitalism, started to fail. And that caused lack of demand. The government never really stepped in to prop up the banks in the Great Depression, and it was a very kind of dire situation. This time around, coronavirus was very, very different. People were told to stay home to essentially stop the spread of the virus. When they were told to go back to work, they did, and the unemployment rate plummeted. So what's kind of transpired since? Well, what we saw was initially people stopped doing pretty much anything fun. And as a result, the byproduct of that was excess savings. And as you can see, from the time that COVID hit through October of last year, we had $1.4 trillion in excess savings that accumulated during 2020. In addition to that, if you look at the deaths caused by COVID-19, this is really a curve that is pretty telling. So the majority of the working population is going to be the 18 to about 64-year-olds, right? This group. These are children; they're too young to work, and these are typically retirees that are already retired. So the lockdowns essentially made everybody stay home. But I would argue that in hindsight, we look at that and it was definitely a policy that wasn't rooted in science. We didn't know much about the disease. And today, the idea of, for example, kids having to quarantine or stay home and not go to school is universally accepted as kind of a ridiculous idea. Kids are not very susceptible to dying from COVID. Thank God for that. And when you look at risks, again, most people have a very hard time understanding risks. It's not that the 2-year-old or the 5-year-old has no risk. It's just that grandma, let's say, for example, is not 10 times more likely than her grandson to die from COVID. She's 10,000 times more likely. And so when we look at this, what this gives us optimism about is that when you think about continued shutdowns or lockdowns in the future, I don't think we're going to be seeing them. As you can see from the numbers, it really doesn't make sense to lock down the majority of society when really the people that we should be protecting and quarantining are the people that are a little bit older. So let's look at cases. Now, this is, again, hugely positive here. Cases which peaked in December timeframe at about 250,000 are now down to about 45,000 with the latest numbers. This is very, very important because this cannot just be explained by the vaccine rollouts. Part of it is the vaccine, but a lot of it has to do with herd immunity. So let's talk about that. The blue line that you see here is really all the people that have had positive COVID tests and have been reported. The gray line is the people that have had COVID but were not reported. So, for example, many of you know that my family got COVID. Well, when we got it, my wife initially was the one that got tested. So she's in the blue line, right? My kids and I, it was pretty obvious that we had it. We had the same symptoms. We never really bothered to go get tested. So we're in the gray numbers. And then all the people that, for example, have had the vaccine at least one dose are in the green numbers. And as you could see, the percentage of the population is now approaching 55% that have had one of these three things, meaning that they have some antibodies against COVID. Also, this number, the average daily doses that we're administering is climbing exponentially. And from the time that the vaccines rolled out, when we were vaccinating about 200,000 people per day, to now where we're vaccinating 2 million people per day. And this graph is before the Johnson & Johnson vaccine got approved. So with that, we're probably closer to 3 million doses a day. We could be looking at 90 million doses in the next 30 days. That's incredible. So this graph is something that I wanted to share. There's been a lot of reports that, there's line cutting, the wrong people are getting the vaccine. We're not seeing any evidence of that. The right people are getting the vaccine, first responders and the elderly. And then as this trickles down to the rest of society, those that are less susceptible to COVID, we expect that these numbers will rise as well. But as you can see from these numbers, about 21% of the population at this point has had at least one dose of the vaccine. And that's one of the best statistics that I can show you here. If you look at the rest of the world, the U.S. can be criticized for its response to the COVID-19 pandemic initially, but in terms of the vaccination progress, we are the best in the world right now in terms of the number of doses that we've given to our population. For a large country like ours with 360 million people, there's no other country in the world that's done a better job. Not China, not Russia, not the European Union. There's small countries like the UK and Israel that have done a little bit of a better job, but they're small by comparison in terms of our population. As you can see from this graph here, the world's had about 2.8% of its population vaccinated. We're at 21.5% already. The last thing that I want to show on this graph is that as Israel was approaching this 60% mark, what you see here is the number of vaccine doses they were administering per day, and then their cases, the number of new daily infections. And you can see that cases have absolutely plummeted in Israel, which is a great sign. This is something that we get to look forward to, and I think we're already there. So we could be looking at herd immunity much faster than I think anybody predicted, which is a great sign. So I'm going to turn it over to my colleague, Eric, who's going to talk a little bit about the recovery and what those indicators are telling us now. Eric, go ahead and take it away.
Great. Thank you, Carl. Everyone here okay?
We can hear you.
Perfect. All right, so mapping out the recovery, where do we see the greatest opportunities and also the greatest risks? So here, the recession risk forecast is now showing us a shift from a recession in 2020 to a current expansion in 2021. And the improvements started to occur leading into the third quarter and also into the tail end of this last year. With progress on the vaccination front, in addition to the sizable stimulus packages, growth or GDP, gross domestic product, is expected to be somewhere between the 6 to 7% range, with some projections even higher, which is sort of astounding. For comparisons, the typical growth for the US is around 2%. Even though there are some soft patches and not all of the indicators are flashing green, we believe that it's highly unlikely to consider a double dip recession, which was a risk many posed, frankly, not too long ago. Also, we are seeing additional positive things occurring underneath the hood, and we believe that we will see a further improvement with things like profit margins and even truck shipments, which is tied to business activity. Next slide, please. So here, where are we in the business cycle? And to better understand this, let's think of various parts of the market cycle as sort of the seasons that we go through naturally. If you look at summer's a good example of years like 2017 and even 2018, whereas fall would be comparable to looking at the second quarter of 2019 into the fourth quarter of 2019, where activity across business, profit margins, in addition to financial metrics from the dashboard, were starting to wane. Winter would represent the obvious, right? The elephant in the room. What was us getting into the government mandated shutdown of 2020, sort of in the abyss of March that we experienced through COVID. Spring, I would say, is where we're at currently. We are seeing a sharp recovery off of the March lows of 2020 with a broad reopening underway because of vaccination distribution and overall comfort levels changing, frankly, for all of us in some way, being more comfortable than we were maybe months ago. And this is already resulting in an uptick or an acceleration in economic activity, which is expected to continue. Now, there are some parallels that we could even make between this environment and what we saw as we started to transition from the great financial crisis from mid-2009 into 2010. In hindsight, that was one of the best opportunities to be fully invested in the stock market. Next, please. Great. So attractiveness of different investment classes. Where do we see opportunities and where do we also see some of these risks being posed? When you consider the restart of our economy, certain parts of the market are more advantageous than others when we look at things broadly. Now, we are seeing more opportunities in areas like stocks and cryptocurrency relative to other categories mentioned within this slide, areas like commodities, real estate, and also bonds. So to dive in and get a little bit more granular, when you look at stocks, and let's start there. When you consider economic reopening, unleashing all of this pent-up demand of all of all of us, basically, us consumers, in addition to approximately, if you could believe it or not, $30 trillion of global stimulus already injected into economies across the globe. And this has all been in advance of the most recent $1 trillion plus stimulus. That environment bodes extremely well for the stocks. More specifically, we are finding opportunities in some of the following areas. Value areas relative to growth-oriented companies. We're starting to see somewhat of a rotation, a shift. In addition, that shift is also taking place in areas like small and mid-sized companies relative to those larger companies. And as you've seen, even some of these big tech names, these larger companies, give some of their profits back or some of their stock gains back over the last couple of months. Value companies have sort of picked up that slack. And then last but not least, foreign markets relative to US markets is what we believe will shine into the future. That'll be the biggest story over the next 5 to 10 years. And in the upcoming slides, I'll dive further into this. Let's shift over to bonds. So bonds as the next category. Bonds can absolutely have a place in portfolios, especially for the benefit of diversification. But when you look at things more broadly, an economic restart or a recovery will have an impact on interest rates and inflation expectations, which can put pressure on those bonds or defensive areas of the market, which is why we're giving it, at least broadly speaking, a thumbs down. Real estate, let's dive into that. Real estate had a challenging year in 2020 when it comes to the commercial side of things, more so than the residential. This may obviously come as a surprise, especially as most of us have seen a boom where it's friends or some of our clients, even family that I have close to me, who has been buying or selling their home very quickly. The biggest concern with commercial real estate has been the unknown consequences of people working from home and what that restart will look like. And to see the reality of the unknown effects on real estate, we don't really have to look that far, to be frank. I think it was 2 or 3 days ago where, as a perfect prime example, Ford Motor Company, here sort of at our roots in Metro Detroit, recently announced that they will allow 30,000 of their employees to work from home forever. That's crazy, but it shows that that shift is sort of underway. What will this future work-life balance look like? Our preference moving forward is to invest in real estate more broadly with exposure to the US market and even more so within overseas markets where growth has more potential. In addition, where we have the ability to be somewhat more selective, we are focusing for our clients on real estate tied to logistics or e-commerce. Think like data servers, in addition to infrastructure. Think of cell towers, not just here in the US, but think more broadly speaking, overseas in areas like India, where one of the best ways for people to communicate and to be a part of society is through their phone, even if they don't have a bank account. We feel that that is very much a part of the future and still underway in these foreign markets. Next, shifting over to commodities. As the economy rebounds, certain commodities can do well, especially as it relates to ones that are tied to areas like manufacturing. But in this case, I'm specifically referring to commodities like gold. Gold is typically perceived as a safe haven type of investment. This is partly why it did relatively well last year, where there was fear and many unknowns with COVID. Now, some have also used gold to protect portfolios against future inflation or rising prices, the cost of things going up. And we believe that there are better alternatives, which allows us to have a perfect segue into probably one of the most notable and exciting areas, at least for me personally, and what you're seeing across all the headlines, cryptocurrency. So cryptocurrency is basically digital money used, and in part, frankly, it's a part of a much larger conversation around the evolution of money and ways to transact and transfer value in some form. And the largest and most notable cryptocurrency is Bitcoin, with a market cap or size right now of $1.1 trillion as of this morning. This makes it one of the largest overall currencies in the world. In addition, in a world where future inflation expectations could continue to increase, we look at Bitcoin as digital gold. It has very similar properties to gold and in some respects, more efficiencies. So if we are looking to have exposure to a growth investment in addition to a diversifier for a portfolio, cryptocurrencies can be a great addition. Next slide, please. Okay, so going back to when I was talking about stocks, this is US versus international stock performance. And what I love about this is it shows that everything has cyclicality in life, but especially with the stocks. And if you look at this, this is showing at the very bottom line. If you look at that axis, it's showing from 1978 all the way up until the present. And it's showing over different time frames when the US market outperformed international markets in that teal color for at times several years. And then in other instances, for a couple to several years, seeing where there could be instances where international markets outperform. So to give an example, from roughly early 1980s through almost the end of the 1980s, international markets outperformed by almost 400%. And then take it a step further, what we've seen more recently since basically the credit crisis, we've seen US markets shine unequivocally, being up almost 200% more than foreign markets. We believe that we've capitalized on this quite well, but if we're looking at the next 5 to 10 years, we believe that this cycle will shift, which is part of our argument for portfolios to make sure that we're emphasizing foreign markets and even more specifically emerging areas like Indonesia, areas like Brazil, areas like underdeveloped Europe, but then even areas like China. Next slide. Okay, which stocks do well following sell-offs? Following the last 7 market downturns, some sectors have rebounded more strongly. So talking again about this rotation, and after you have market drawdowns, what you should anticipate to do well with certain categories or sectors of the market, this graph does a great job of articulating that. So if you look here on the far left, this shows relative performance of different areas from utilities to energy all the way down to IT. And if you look here, it shows that the areas that have done the best overall after market downturns, and think of after COVID going into this year and beyond, we feel that there's a need to emphasize and to make sure that we focus on areas like consumer discretionary, industrials, financial companies, especially as interest rates start to go up or inflation, and then also IT-related companies, showing that they do the best. And if you want to be able to track that, we have these hit rates where it shows basically the success rate being 71 to 86% of the time actually being positive. Next slide, please. Okay, so U.S. debt levels set to rise higher, bearing a change in spending. U.S. debt levels will likely grow substantially in the coming years. I would say that that's an understatement. We all know that debt has been rising over the years, but I think that this graph makes it truly impactful to understand the magnitude of it. So if you look here at this far graph, this on the left shows us federal public debt held since the 1790s. So yes, we got data going back the last couple hundred years. And what I want you to really take away from this is the expectations through 2040 and beyond, where we are going to get to potentially 200% of our GDP when you look at overall debt. If you look at where we're at now, just looked at this morning, we were just in excess of 120%. With some of the stimulus that has been put into play between last year and more recently with President Biden. That puts us above the debt levels that we saw in World War II. In addition, if you look here on the far right, it shows U.S. budget as a percentage of GDP, also showing that magnitude since the early 1930s, that we haven't seen this much of a deficit going back to more comparable timeframes of, again, World War II. So showing that we have an issue, but as I would put it, it's a much bigger conversation that ties into what will future taxes look like if someone has to come up with paying this bill. Next slide, please. So now I want to kick it off to Greg Marx to dive into how really everything ties into the debt increasing, but also what that means for stimulus paychecks, but also being able to knowing that maybe taxes could rise into the future, tax reduction strategies. Greg, take it away.
All right. Thank you, Eric. Cindy, am I good on audio?
You sound great.
Okay. All right. So as you can imagine, being a CPA the last couple of years has been pretty exciting and very busy. And we're seeing in 2020 and on into 2021 that the IRS is essentially assembling the airplane while it's already in the air. A lot of changes. It seems to be every week there might be a change that is retroactive to the start of the year. So we can start with, as Eric was talking about, the spending. So Trump era tax effect that went into place in 2018 is set to expire at the end of 2015 or 2025. So in 2026, you're going to see many things change. Exemptions going away. You're seeing standard deductions decreasing. There's going to be a broad increase, if nothing else changes, of about 3 to 4% in the standard tax rate for everybody above the 10% tax rate. So anyone who was up to 22 is going to go up to 25, et cetera, for either 3 to 4% for every single bracket. You may also see some of those brackets shrink. So that somebody who is in a lower tax bracket might suddenly be in a much higher bracket, so they're going to see a bigger increase than 3%. And as you can see, there's a little at the end. I believe that's 2026. Is that it takes a little bit of a hike, but that is if nothing happens. As we see, there's constantly fighting in Congress with one side or the other, kind of using tax rate as a bargaining chip. So we don't really know what is going to happen beyond what is just currently set in laws. So beyond the reduction of reduction in exemptions, there's also the child tax credit is going to become less powerful. It's going to go down. It's going to be halved from 2,000 to 1,000. The income limitation that will let you phase out of that goes from 400,000 back down to 110,000. So a lot less people with kids are going to qualify for it. Beyond individual tax rates, there's talk of the corporate tax rate going down or going back up because currently it's a flat 21%. That might jump back up to the 35 to 37% that we've seen in the past. Estate tax, there is a lot of talk in Congress about changing the exemption. The estate exemption for 2021 is currently 11.7 million. So if you have less than 11.7 million and you die, you will not pay any estate tax. If nothing changes in 2026, that's going to go back to 5.6 million. Still a high number, but it's half of what it was before. There's also talk about reducing that down even further to 2 or 3 million or maybe 1 million. There's also a talk about getting rid of the step up in basis, which is a big tax planning item that people use to avoid having to saddle the next generation with a ton of tax debt. So there's a lot going on with these with tax rates that we are still experiencing every day, and they might make a tax law and it will be retroactive to a few months before that we have to try to catch up with. And on the next slide, you will see the unemployment benefits. So normally the standard benefit for Michigan is $362 a year or a week. That is if you are an employee and you get laid off. You get that. For COVID, they made some changes. They adjusted it to now it's called the Pandemic Unemployment Assistance Program. So it's still the $362 a week from the state of Michigan, but it's also anywhere from $300 to $600 from the federal government in supplemental benefits, depending where you are, because that's another item that is being kind of a bargaining chip in Congress. It was $600, it dropped, it was going to expire and go to $0. It got extended to $300. You hear them both sides of the aisle kicking around $150, $400, kind of back and forth. That's what they're talking about, is that supplemental amount in addition to the $362. So that is set to run through, as of right now, it's set to run through October. That could change. It was just extended to October last 2 Wednesdays ago when some other changes also happened. So that is the unemployment side of it. Also, if you are in a business, you previously could not qualify for it. Now you can. If you had a reduction in your income in the business, you could actually qualify without having to file against your own business as being laid off. So that's just another one of those. A lot more people can qualify, and the benefit has doubled or tripled from what it normally is during the COVID period. So we move on from unemployment to the stimulus, or as many people like to call it, the stimmies. This is something that we just had our third one. Many of you may have gotten it somewhere between last Friday and today. I think the big rollout for direct deposit was Wednesday of this week. Wednesday and Thursday was when a majority of them came in. If you don't have direct deposit on your tax return, you may have a paper check on the way in the mail. So look out for that. That one, as you can see, essentially the program is it's the same across all three of them, but there is different qualifications. From the first to the third one, there is an increasing income limit to having to get phased out, if you will. So the first one, if you were married filing joint and you made between 150 and 200, you were phasing out. The second one, if you made between 150 and 174, you were phasing out. And the third one, if you're between 150 and 160, you're phasing out. If you made over that, you got nothing. And what the IRS uses is your most recently filed tax return. So if you haven't filed for 2020 yet, they use your 2019, potentially the first stimulus payment that was paid out in April or May of last year would have used your 2018 tax return unless you filed your 2019 return very early. So it's an advanced tax credit for 2020. If you didn't get as much and your income went down in 2020, as you file your 2020 tax return, you're going to get more money back from this program. If you got too much, if your income went up in 2020, then you are not going to have to pay anything back. There is no clawback in this program. So it's only beneficial for you on your tax return. You're either going to get no more or you're going to get some amount back that's just going to increase decrease the tax you owe or increase the refund that you're going to get. So that's the stimulus side. We move on to the next slide, which is the business assistance from the government. So this is, you may have heard in the news a lot, talk about the PPP. So the PPP was the biggest program of all this. This was a loan that if you followed the guidelines of the program, you could get it fully forgiven. And as the program went on, the rules changed and became easier and easier to get forgiveness. The period that you had to pay your payroll expenses to get forgiveness was extended from 8 weeks to 24 weeks, which made it almost automatic for almost every employer as long as you still had employees that you were paying. And then as of December 27th, which was 8 months after we were applying for these loans for people, we found out that it was going to be tax exempt. And then at that point too, we also learned that you can take the PPP and the employee retention credit at the same time. Prior to that, it was one or the other. And the PPP was better for people. It was more immediate. It was easier to get. So most picked the PPP. The economic injury disaster loan was an SBA loan. It was adapted from an existing program. And what it was up to a $150,000 loan that you could get in between 10 to 30-year terms at 3.75%, and it had a year of deferral on your payments. So it was a nice, push of money up to the business for them, but it was still a loan. So after a year, they have to start paying this back, really long term, kind of like a mortgage in your business at a very low rate. So it was still good for people. But the best part of that program was the grants that they created. They had a grant part of the program. When you applied for the EIDL loan, they gave you a grant of $1,000 per employee, up to $10,000. That item also, as of December 27th, was treated as tax-exempt income. So it's free $10,000 they gave out to anyone who applied and got to the program. The employee retention credit is the latest comer to the party. It was misunderstood for a long time. Less people qualified for it. Most recent changes have made it much easier to qualify for. It is a payroll tax credit, so it can be done with an amended payroll tax return. Therefore, there's no real deadline on it other than the 3 to 4 years after that is the amended statute that you can file. So we have a ton of these that we're going to be looking at this summer to do, and most CPAs are going to be doing it after tax season to get people back money. And there's a very harsh reduction in revenues you had to have during 2020, but in 2021 it's much easier to qualify for it. And you also can qualify if you had a government mandated shutdown for that period that you paid payroll. You can qualify for the credit as well, and you don't have to have the reduction in credit. So that's a large amount of our clients. What they're dealing with is that government mandated shutdown. Generally March through May, maybe into June for some clients. But it was a government mandated, and it was, as you know, there was a lot of shutdown mandates, all different industries of different periods of time. So that's something that you're going to want to talk to your CPA about, and confirm those dates and when you paid payroll, and get those credits back. You can also not share the same wages with the PPP forgiveness and with the ERC. Those have to be separate wages. So you might run into a limitation issue versus getting free money and getting a free credit. One thing to mention about the ERC as well is that it's a credit which reduces your expense, which technically makes it taxable, unlike the PPP and the EIDL grant. On the next page, we have potential tax savings. These honestly are not new for COVID. These have been around for a while, but they are, any good CPA and financial advisor will let you know of these and have you participate if it makes sense. So HSAs, one of the favorite things to do right now. Essentially, it's a Roth IRA with the benefits of a traditional IRA all rolled in, and you're going to use them in some time in your life. You're going to use them for medical, for premiums, for medical care. It's going to happen. So it's not something that you're going to lose ever. You must be in a high deductible health plan to qualify to contribute into the plan for the year. You can contribute up to 3.5 months after the year, so you can contribute to April 15th for 2020. You can still contribute, and it will give you a tax deduction in the year that you do it. So that is a top item for people that qualify. But the biggest thing that disqualifies them is being in the high deductible plan. Backdoor. Let's start with a traditional and a Roth IRA. Those are self-explanatory. These are items that you can contribute into a individual retirement plan. You want it pre-tax, you want it after tax. There is income limits to contribute into a Roth. If you can't, you may qualify for a backdoor Roth, which is down there in the bottom left. That is an item where you can actually contribute and then roll the money in, as long as you don't have a pre-tax basis in another IRA account. That's another one you want to talk to your CPA and your financial advisor about. I know Eric and Carl love doing those, and I love doing them too. Solo 401k, if you are a business owner, great way to defer income, especially in high income years. You can also set up a pre-tax and a Roth component to those, and contribute. And depending where your income is going to be at, you can contribute a certain amount to either one based on tax rates. As we just talked about, tax rates probably going up. Good time to contribute to a Roth component on it. Qualified charitable distribution. This one is, rather than getting the money into your pocket and turning around and giving it to charity and taking it as a charitable deduction, you can have it go directly from the IRA into the charity. And what it does is it comes off the top line. So what it does is it doesn't show up in income. You don't get to take it as a charitable deduction. You are not taxed on it from state tax, which is usually the biggest drawback to having the money paid out and then contributing to a charity outside of a QCD. So those are great items that are being done. It's also a big side. If you on the left side, there was no RMD required for 2020. So we are seeing 2021 RMDs being very heavy for people that did not take the RMDs, because it's just a higher basis of what they have to draw from. So that is mine, and we can move on to Cindy for Q&A.
Thank you so much, Greg, Eric, and Carl. If you all have time to stick around, we would love to open this up to a Q&A session. So as a reminder, you can submit your questions using the chat feature. You can select just me to chat to. We did have a couple come through, so I will start with that. And all three of you are open to providing the answers for this. So the first question we have is, what are your thoughts on government debt and inflation?
I could take that one. So government debt, as Eric showed in his slides, is approaching very dangerous levels in our opinion. It seems like no political party is really interested in tackling this. You can see that we're already above World War II levels. And today, the interest rate on government debt is almost at an all-time low. A 10-year treasury is below 2%. It's at about 1.3, 1.4%, I believe the most recent numbers are. So the market isn't really making the government pay higher interest rates, but that may be beginning to change. And as the market is really unwilling to lend to the government over time, a larger share of the budget will need to go to interest payments, which by default will mean that the there will be less money left for the other programs that are out there. Inflation is a real concern for us because unlike the global financial crisis, where most of the money that was given to banks, which then later paid it back, and that money was then destroyed, today these payments are coming in the form of checks to individuals, and those individuals are spending that money. And already we're seeing that where they're spending the money, inflation is rising. So, for example, many of us have done home improvements over the last year because with the COVID lockdowns, it's the one thing that we could spend money on that wasn't involved with experiences or travel. By spending money on things like home improvements, the costs of everything related to home improvements have really skyrocketed. A 2x4, which used to cost about $4, is now $7.50. That's nearly double. And I want you to know that the U.S. is not lacking in trees. We're the Saudi Arabia of timber. So it's not like there's a lack of supply. It's just that demand is really outstripped supply significantly, leading to significant inflation there. So inflation is a really big concern of ours, and it's already starting to show its head in certain areas. But overall, inflation as a whole has not taken hold in every area of the economy. The inflation rate is still below the 2% target that the Fed has set. So hopefully it won't infect every part of the market, but that is something that we're watching very closely.
Let me add to that, Cindy. To piggyback off of what Carl was saying, we do not see inflation expectations becoming unanchored as they did in the 1970s. I think it's important to acknowledge that elephant in the room, right? Because when people think of inflation and they look at where things are at currently, we've had this come up in meetings on countless occasions where people say, Eric, is it going to be as bad as what we saw when rates started to get into the double digits and mortgage rates were into the teens? So I wanted to address that directly. We don't think that is likely. That's not our base case that we're leading in with. We do see U.S. inflation averaging just under 3% between 2025 and 2030. That's not that big of a deal. Secondly, we believe nominal government bond yields are not likely to respond as they have historically to higher inflation, given really the involvement that central banks have had. They have more of a tolerance for inflation, and they have a willingness to limit these rises in bond interest rates to avoid tightening of financial conditions. In short terms, just know that with all of the mechanisms that have been in place that the government has at their disposal, they're going to be able to control things to where things we believe will not get out of control. Okay, that's it.
Thank you, Eric. Our next question is, if there's a thumbs down on bonds, why should I invest in them?
So bonds have a very specific role in the portfolio. Bonds act as ballast, right? So think of them as a dampener for the rest of the portfolio. Even though bonds look relatively unattractive compared to stocks in terms of their absolute returns, bonds will still likely make money. There's never really been a period in history where bonds have lost money for more than about 3 years in a row. Bonds have also come down quite a bit over the last couple of weeks. And so they will produce good gains. The problem with taking bonds out of the portfolio entirely is that if we see weakness in the stock market, which is inevitable, by the way, so even though we don't see a recession ahead, that doesn't mean that we're not going to see corrections or volatility. We're losing a very important tool to kind of dampen that volatility, and it will create a portfolio that's less predictable, less consistent over time, and maybe outside of someone's risk tolerance. So we like bonds as a dampener for the portfolio. We also like them for their price stability. And for many of our clients that are retired, that's where we take their distributions from, their income. So bonds have a role to play, but relatively speaking, they're less attractive than stocks today.
Thank you. Next question is, are there any
I got
updates
an
on the
update.
government
They
forgiving
haven't.
$10,000 of
The new,
student loans for
tax law that
individuals?
came out last Wednesday it had a lot of things that both sides were talking about. It had two absent items that were in the news. One was the the student loan forgiveness. The other one was the $15 minimum wage. Those were the two significant things that were not included in this latest bill. So yeah, no change to that. It's still a heavy push towards the Democrats pushing for at least some forgiveness. What that dollar amount is can change, and the other side, always referencing the budget and the government spending and not wanting to do that. So they have to have something on the other side that they really want, that the Democrats are willing to give in on, for it to get passed, as we're seeing with this tug of war that's constantly happening.
Thank you, Greg. Next question is, how is cryptocurrency affecting portfolios, and what is that relationship with the dollar?
Eric, do you want to take that one?
I do. I was just taking a note. Good question. So, if you look at the relationship with a portfolio, the best way to describe it is we are looking at this from a standpoint of sort of the ideal diversifier. Let me break that down. In a perfect world, when we're diversifying any portfolio, to smooth out that ride for a client, you need to have things that diversify, that move or zig when other things zag. So if stocks are going up, you want bonds to maybe offset that and go down. And what's beautiful about cryptocurrency, or even more specifically Bitcoin, the biggest one of them all, it has different catalysts that impact that versus what might impact things like the stock market or the bond market. So from a portfolio standpoint, to try to have things built out together, we like it for those purposes. We call it a non-correlated asset in some respects. To address more of the relationship to the dollar, I will talk about that broadly. Just know that as there has been more and more government debt in the US and also abroad, and there's the concern of these debt levels. There's somewhat of a catalyst for cryptocurrencies to be an alternative when some of these currencies are starting to become somewhat devalued. And on the surface, if you have all of this debt out there, technically the dollar and other currencies can be worth less, which sort of ties into where we've seen the US dollar devalued. So that is just one of many catalysts that sort of play into a positive for cryptocurrencies. But I would say there's many other reasons that are also making this quite attractive. And I'll pause it there. Know that we are excited about this topic, and if you are interested in learning more, feel free to reach out to me directly. In addition, we're looking to build out our next fireside chat focusing on this topic and really breaking down this world of the future tied to this and even the infrastructure, blockchain technology.
Thank you, Eric. Next question is, now that we're coming out of the pandemic, are you changing stock investments to different categories, like moving to cruise companies, etc.?
No, not necessarily. This is one area where some companies are going to be forever altered. Meaning, because you didn't take that cruise last year doesn't mean you're going to take 2 cruises this year. Same thing with airlines. However, there are other companies that will make up their sales, and in those categories, we definitely are interested in piling into those companies. But primarily, what we're looking for is who's going to thrive well in this environment. A good example of something like this might be, a company that's in the home fitness, area, right? A lot more people are working out from home. That's something that's been an area that's been booming, and we don't think it'll necessarily stop booming because of COVID being over. So something like that, where it's more of a trend rather than a fad, is what we're interested in looking at.
Great. Thank you, Carl. Next question. It looks like two questions for Greg. Greg, you spoke about the tax breaks that expire in 2025 from the Trump administration. Without knowing what
Yeah, I
administration will
could
be in
see it.
office by
I could
that
see at least
time,
maybe
could
they
you
pick
see
and
someone
choose parts of it
extending
to
that?
extend. If there's another Republican, either Republican president or Republican majority in the House or the Senate, we could see an extension of some of the items. A lot of the tax effects that are currently in place are because of the long existing credits that just get extended. They kind of got kicked down the road. So I would see possibly things changing. Rarely do bills actually kind of expire. They usually get tweaked. They might accelerate the end of them by a couple years, or they might get extended out another few years. The reason why those tax cuts weren't permanent is that there's a law in Congress that you can't actually extend the budget revenue by more than the amount of time that they had, for the 7-year mark that they did. So that was the reason why they were set to expire, is because you can't make a sweeping tax change last permanently.
Thank you. And there was another question for you, Greg. My wife is pregnant. Did you hear
For
anything
someone
about
who
getting
is
a
pregnant,
$1,400
well,
stimulus
there
check
is
for
talk
someone
about
who's
in the new
pregnant?
tax law about giving advanced child tax credit. So instead of filing your tax return the next year and getting a certain amount for the kids, they were going to roll out payments of $300 or $360 per month from July until December. That has yet to be seen, and how it is working, we're not sure. They just recently made 10,200 of unemployment benefits tax free for each person. They're not even ready to handle that yet either. So anyone who needs to amend, who's already filed, the IRS is telling people not to amend yet, because they're not able to handle the amendments, and they don't have the exact calculations for us to actually update our software for us to file anybody who has that. So there's some things are set in stone, other things are being worked on, and other ones are just pure conjecture. And that's one of the items they've talked about it, but I don't know how they're going to roll it out. And as far as I know, for a benefit, as long as the kid is born by the end of 2021, you'll be able to get a child tax credit in 2021 for the child. I have not heard of a prior to being born. So if it's close, you might want to have a scheduled C-section. If it's within a few weeks, and get the credit for the kid in this year. I'm kidding, of course, but I have heard people do that. Mostly other CPAs. Yeah.
Always thinking about always thinking about the taxes. Great. Thank you for that. I think we have time perhaps for one more question. Again, if you have any other questions, please feel free to use the chat function. We do have a question here. Greg, I haven't submitted my taxes yet, and because of
I'm assuming that means
UIA,
unemployment
has the new
benefits,
stimulus
income from your
affected previous
1099-G that you would have
UIA?
gotten. If your income is 149,999 or less, you get the first 10,200 exempt from taxes. If it's higher than that, you get no additional amount, which is where we're seeing if you made $1 more of income at this point as a cliff, you would pay another between $2,500 and $4,500 of tax, just because you went over that income limit. So you get the first 10,200 as long as your income is under 150,000. If it's over that, you just get to pay tax on the whole amount. That was as of last Wednesday.
Great, thank you. We do have quite a few requests for Greg's information, so I can forward that out to those of you asking. But again, he is Greg Marx, CPA with Robinson, Petrus, Kaliski and Company. They are out of Farmington Hills. But again, I can get that information out to those asking. Thank you so much. And if there are no other questions, that concludes our fireside chat for today. Thank you, everyone, so much for joining. We truly enjoy sharing these educational pieces with our clients and friends and family. So thank you for that. This will be available as a recording on our blog, which you can find at verdecm.com. And as always, feel free to follow us on social media. We are on Facebook, Instagram, and LinkedIn. We do post some fun and informative content. If there's anything you would like to see, feel free to give that to us via feedback in an email, or any other topics you would like to see discussed in future Fireside Chats. Thank you so much to Carl, Eric, and Greg for your presentation and your knowledge. And yes, that concludes today's chat. So thank you again.
Thank you.
Thank you, everybody.
Have a nice weekend.
Bye-bye.
Bye.